Good evening. This is Ken Long from Tortoise Capital Management on the evening of 30 November 2010. I'd like to take a quick look at the market health check today. And you can see we're looking back 10, 20, and 30 days to define our recent market condition. The black lines are the 30-day regression line and channel. The slope is still slightly positive, but you can see for about 30 days we're right back to where we were 30 days ago, except for that little blip right here, a steady sell-off. I'm looking at support around 118, which is the a coming together of the 20-day moving average in green, the 50-day moving average in red. The fact that it's tested and held this 1, 2, 3, 4, 5 times in the last 10 days. There has been a little bit of buying pressure, but no follow-through to go back and retest the previous swing high at 123. ADX is still down around 15, which is basically a sideways market. Red is still in charge because of the sell-off from 123. That's why red is above the green on the ADX. On the Williams percent R10 basis, the market has been oversold twice in the last 10 days. There's been a little bit of buying pressure you can see here, but nothing that gave us the retest of the previous swing high. The longer that lasts, the less good that is for the continuation play. But what I'm seeing right now is a flight to quality in the U.S. There's a combination of panic in Europe over the magnitude of the sovereign debt crisis, and Europe is down 20%, while in this time SPY is down from 123 to 118, or a little less than 5%. So even though this has been an orderly pullback, it's nowhere near the pain and suffering that Europe has endured. And Asia has been punished just as much, I think, because of a reaction or a fear from the domino effect from Europe. And so we've actually seen a flight to quality in terms of the U.S. market and buying the dollar. Even though there's not a lot to love about the dollar, it's not as bad as the euro or the Asian currencies. Gold and silver and the other precious metals are making a nice move up after a profit-taking pullback. Some would call that market manipulation, trying to shake out the weak hands. I looked at it as an opportunity to buy more, and I'm glad I did. Silver is still leading the way north as that hedge against inflation, buttressed by its industrial production value. So in general, what I'm looking at here in SPY is a failure to fail further. I mean, it's had a 5% pullback from 123 is nothing more than ordinary noise, and the fact that it's held this red line at 118 is key. And I think support from the 50-day moving average may be in effect as well. Now, if it fails from here, though, in other words, if price breaks down below about 117.50, the next move is to 116, so that's 1.5%, and then the next support doesn't show up for 113. If it fell all the way back to 113, we'd be looking at just a 10% correction from the swing high, which would take us right back to the boundary of bear markets at the 200-day moving average at 113. So it wouldn't surprise me to see a test down to 116, and if that fails, it goes to 113 in a hurry. That's a trade that you would want to be all over, using 113 as a target, and then of course using other exchange-traded funds or large-cap stocks that are strongly correlated with SPY would be prudent. The financials have been suffering a lot, and so if we see the market failure and XLF failing further, then you want to be on board SKF, the double inverse financials, because that'll really do well in the case of further market failure. But if the U.S. market starts failing, then I think it's Katie bar the door for Europe and Asia, and you could also be looking at symbol EEV, which is the 2X Emerging Markets Inverse Fund, or EPV, the double inverse European ETF. Any of those targets are going to be excellent for you, and I think you would have a great luck trading those if we see a breakdown from here in SPY. But if SPY resumes its move north here, then the candidates you want to look at are the two strongest sectors in the global market, for the U.S., which is the technology which you could play with QLD, the double long NASDAQ, or MVV, the double long U.S. mid caps, which have been very strong, and even TWM, excuse me, the double long small caps. So keep your powder dry and your eye on the market. Remember, SPY calls the tune. I would be continuing to buy SLV silver or AGQ, the double long silver ETF, on any evidence of momentum. That's a small market, and it's going to benefit more from fear than the gold market will. So that's Ken Long from Tortoise Capital. Good hunting and good trading.